All right, it's 1 o'clock. I think it's time to start moving on our presentation. First, I'd like to thank everyone for taking the time to join us today. This is part of our ongoing rental expert series, which we do in collaboration with NAR. Today's webinar is Unlocking the First-Time Buyer Market, What Agents Need to Know. My name is Josh Taylor. I'll be the host, and I'm very excited to be joined by Ryan Jamie from Leader Bank. So let's start with some introductions. Again, my name is Josh Taylor. I'm the Vice President of Operations at Rental Beast. I've been with Rental Beast for probably about 10 years now, and before that I was in the world of finance. And we have Jamie joining us. He's been a mortgage professional for almost 10 years now. He's originated just shy of $200 million, and we're really excited to have him because he's done so much with the first-time buying community. So a lot of knowledge and strategies and expertise that he'll be able to share with the real estate agents on this call, specifically around first-time buyers. In terms of what we'll be covering today, I'll take the first couple sections. I'll talk a little bit about what the market looks like to a first-time buyer, how the first-time buyers fit into the marketplace. We'll talk a little bit about their profile, and then I'm going to hand it over to Ryan, who's going to give us the lender perspective, which is obviously key as you're going through the purchase process. So he'll talk about some of the things he's seen, some of the things that make funding more likely, some of the traps that agents and borrowers fall into. Having worked with hundreds of agents over the years, he's got all sorts of great strategies and tactics for us. So we're very excited for that part. At the end of the call, also, I'm going to give you a sneak peek at a product that Rental Beast will be introducing soon that is intended to help agents convert renters into buyers, which will be a member benefit. And then we'll wrap up with some questions from the audience. All right, so first things first, let's talk a little bit about the market conditions, what things look like in the world of housing to a first-time buyer. And at a very high level, it's something like this for a first-time buyer. And the good news on this slide is, as recently as probably a year or 2 years ago, everything on this slide would have been red. All signs were stop, don't proceed. But we're seeing a lot more green, which is great. As we look across the screen, starting with the headwinds that first-time buyers perhaps perceive about the market is, house prices are high, rates are high. I think that's a general perception that a lot of agents probably encounter in their day-to-day. But as you're moving from right to left, we're starting to see more and more green. In terms of the broader economy, things like employment, opportunity, it's a mixed bag, right? And I bet as you look across your client base, as you look across the renters you're dealing with, on one day, you may see someone who's very happy about the direction of the economy. The next day, not so much. But it's mixed, whereas maybe a year or two ago, it would have been kind of all gloom and doom. The next one, which is critical, perception of rates. So are rates high? Are they low? If you were dealing with a client from a couple years ago, of course they're high, right? They were at 3%. But if your client's context is what's happened over the last year, they seem like they're getting lower, right? And the longer that these rates are staying in this kind of 6.5 range, the more normalized it will get, the perception of the rates will get for your clients. Increased supply, I think all of the agents out there understand that this is happening. Of course, real estate is local, but we're seeing this across the board. And improving affordability. And what I mean by affordability, and when you hear this term in housing, is essentially the price of houses is increasing more slowly than rates are going down and income is going up. So if you look at your monthly house spend as a percentage of your income, it's been more favorable recently, which makes people feel like they've got a little more money in their pocket. So again, kind of the takeaway here, twofold. It's much better than it has been. We're seeing a lot more green. And I think as you look across your client base, right, you're going to see different people fitting into different categories along this spectrum. In terms of your role, and we're looking at Realtor.com's interpretation of months supply of inventory. So we are now kind of in that 4 to 5 months range. And what that means is a more balanced market. Previously, it was a seller's market, right? If something was for sale, you were just providing access. As we approach a more and more balanced market, I would argue that this is a time where agents who are effective at shaping their clients' perception of the market and agents who are very effective at understanding what they are looking at and helping their clients understand, those agents are going to be successful, right? There's much more room now for a knowledgeable agent, whereas before, agents were, in a lot of cases, about access. And this is where we would expect those agents who are good at their job to really step up and take market share, right? So I think this is very encouraging in a general sense. In terms of where first-time buyers fit into the market, the story of renters in the housing market is one of size. Somewhere around 40% of the housing market is renters. As you approach suburban and urban areas, that gets closer to 50, 60%. And specifically, when you look at renters as a channel for first-time buyers, right, somewhere around 70% of first-time buyers are coming from rentals. And we're just talking massive numbers here, right? So this is a huge market. If you are an agent that's in the business of helping your clients with housing, you have to be tuned into what 40% of the market is doing. And of course, in the context of your buyer pipeline, this is critical. Again, somewhere around 70% of first-time buyers are coming from the rental market. And the good news is it's growing. We're seeing more and more renters with higher income in the market. We're looking at an 8% increase year over year in households with $75,000 or more, which is very encouraging. And the stats on the right, I thought this was pretty interesting. This is pulled from Zillow. And they were surveying renters who recently moved. 25% of recent renters seriously considered buying. 1 out of every 4 renters who moved was seriously thinking about buying. These are huge numbers. And then if you look down, you're seeing 37% of renters plan to buy on the next move. So as an agent, you're engaging them now. You're going to be front of mind when they move if you're doing a great job. This is an important pipeline for you. And 42% of renters are likely or very likely to buy if rates drop. So this is a skill, and we'll talk about this in a second, but converting renters into buyers, the market is massive. And if you're thinking about it right, you've got a massive opportunity here. I wanted to kind of bring this to something that's almost a little more tangible for the agents out there. So I picked a handful of markets and looked at what is the price if you're purchasing a house, how much are you paying each month? And this includes the mortgage, PMI if it's relevant, taxes and insurance. This is approximately what you're paying in these 5 markets. So if we look at Miami, for example, you're probably spending around $4,000 a month. This is the MSA, not Miami proper. We also pulled how many rentals do we have right now on the market in the Miami MSA where the rent is at or above $4,000. And again, our example here is Miami. We have 7,100 rentals that are currently available at a price that is at or above what you would likely be paying to buy a house. These will get filled. This is 7,000 people, and this turns over every month or so, that are coming through as renters that are paying the same price as a purchase. What are they paying up front? Probably a few months' rent. They're probably putting down $15,000 or so. So as you start to think of it this way, there are a lot of renters who look a lot like buyers. And RentalBeast puts out a quarterly report with NAR. In Q3, we saw the tightest spread between rents and monthly purchase payments. So this has continued to compress over time. And again, it's just to say, when you see a renter, they may be a buyer. You may be looking at a buyer. So kind of summarizing all this stuff, well-positioned experts will win. We know it's just a fact that renters are a huge part of the housing market. We know that renters are the largest source of first-time buyers, and we know that the number of high-income renters continues to increase, right? This is a marketplace that we are aware of. So you as agents, as you're thinking through how can I increase my channel of buyers, how can I look out a year and make sure that I'm putting my business in a place to succeed, I would strongly encourage you to think through how am I actually converting renters into buyers? How am I identifying the people that should be buying? And how am I helping them transition, right? This is a skill. It's not something you just ask off the cuff. There is a skill to how you transition renters into buyers. For those of you that are a little more visual, I think I would say we're somewhere on the left. There is a massive amount of untapped wealth all around us. You want to make sure that you're putting your oil derrick kind of positioned in the correct point, right? Who are the renters I'm spending my time on? What do I need to do to make sure that I can convert them into something that is really going to help my business? We're not quite on the right where you can just walk out, sign up a renter, and convert them into a buyer. All right, so a key question is, what does a renter look like that will likely become a buyer? We'll just start with the profile of a buyer, and I know Ryan's going to supplement this with some more information that he is seeing in terms of the borrowers. So 70% of first-time buyers approximately come from rentals, or this equates to about 20% of all buyers. 20-25% kind of bounces around are coming from rentals. Median age around 40 years old. I've seen different stats from different sources. This is NAR. Seen from the New York Fed somewhere around 36. But as you're approaching kind of that mid 30s range to late 30s range, this is certainly a prime area for first-time buyers. And in terms of the household composition, I think a decent rule of thumb is the larger the family's getting, the more likely they may be trending into buying. So if you see a committed couple, if you see someone with kids, it wouldn't be a stretch to think they have buying on the mind. The desire remains strong. So there is this narrative out there that there's just been a change in preference, that younger folks are not interested in buying, they prefer to rent. There's just not a lot to support that when you're looking at actual numbers. I thought this was pretty interesting as we go kind of to the younger Gen Z demographic. 86% want to own. This is a Freddie Mac survey, fairly recent. They think it is a status symbol. They think it is very desirable. Whatever the reason, though, around 86% want to own. And they picture themselves being about 30 when they're purchasing, right? So this is something that is not an immediate goal, but it's not far off. So I would argue that there's nothing that's changed. People still want to buy when they can. What do we see that triggers? A lot of this stuff is probably very intuitive, right? We see lifestyle changes, people getting married, people moving in together. Could be kids, perception of security. Again, perception being a critical word here. Could be a stable job. It could be a new job that has a lot of promise. So all of these things are trigger points that, as an agent, you can think to yourself, I have a client who I believe wants to buy. They've had this life change. I think it's important for me to reach back out to them and see where they are. And then this is always a big question, the down payment profile. So what does the down payment look like for a first-time buyer? The median down payment is somewhere around 10%, so nowhere near the 20% that you often hear. And of course, they themselves are paying for this a lot of the time from savings, from financial assets. But a lot of the time, too, there's some gifting that goes on to help the down payment. So the renter that you're helping may not necessarily have that full down payment ready, but they may have access to someone who is willing to help them out. Just something to think about as you are helping your clients. All right, let me wrap up with some challenges that we know that first-time buyers cite, holding them back, and then we're going to shift over and have Ryan walk us through his perspective of this market. I have financial challenges buyers face, financial in parentheses, and I'll talk about that in just a second. But of course, one of the the big constraints for our first-time buyers is the cash needed up front. That's the down payment, but it's also the closing cost, right? So this is a big one that we likely have to overcome as we're helping our renters become buyers. The other one that we see a lot is the debt to income, right? There's a little too much debt on their personal balance sheet. So these are the financial conditions that we see often slowing them down or holding them back. And then I have financial in parentheses because sometimes our financial challenges, our clients' financial challenges, are not actually financial, they're more about education. We have a number of our first time buyers who either overestimate how much they need to put down, or they think it's 20% or something that's much higher than it needs to be. They think they have to save up for 20% to buy a house. So there's an education component as well that's holding back a lot of these first time buyers. And then finally, it's the process itself, right? A lot of misconceptions exist about how hard it is to get started with the process. Going through the mortgage process, going through the home buying process, experiences, of course, are very different, but a lot of consumers, somewhere around half, are immediately turned off by the challenge of how hard this is going to be logistically to get done. So anything you as an agent can do to kind of help your clients understand, oh, it's actually broken down into pieces. It's not actually that bad. I'm going to help you through it. These are all things that can help us as we work to transition our renters into buyers. All right, so far we've talked a little bit about, and I would want you to take away from the conversation so far that the renter market is massive and it is an important channel into the buyer market. The size of the rental market itself means you've got all kinds of clients who may well be first-time buyers, and you need to make it your job, make it your practice to sort through and try to focus in on the people that are most likely to buy, that you can spend time to help nurture. Critical to that is understanding what a first-time buyer looks like. Also critical to that is understanding the likely objections that they will have. All right, I'm going to go ahead and hand it over to Ryan. Again, he joins us from Leader Bank. This is a nationally chartered bank, national lender. They are the heavyweight in Massachusetts. They're the largest lender in the state of Massachusetts, despite the national footprint. They've done billions and billions in assets, top charitable contributor. And I love this last one, the NPS score of 84. For those of you that are not familiar with this rating, it means their clients love them. So Ryan's joining us from Leader Bank. Again, Ryan himself has almost 10 years of experience. He is based in Massachusetts, although in the talks before the call, it's very obvious that a lot of his business is elsewhere. He had cited Texas, Florida, and the Carolinas as being some of the areas he is most active with. So with that, Ryan, let me turn it over to you and hear your perspective and kind of the mortgage professional's perspective on all this.
Thanks, Josh. Yeah, and really happy to be here today. And yeah, we are based in Massachusetts, but we do a lot of loans, and the majority of my loans all across the country. So I get perspectives of the clients, wherever we are. So again, it's not just Northeast. I'm working with people in Texas and California and everywhere. So so these are some of my perspectives on what we see. And first, I just want to talk about some financial signals that give me an indication that a buyer is, a renter is ready to buy. So first is the credit profile. So we typically look for a minimum credit score of 620. If I'm working with somebody who is sort of at that 620, then maybe, potentially that's not a signal that they are ready. I would say if you're talking to your clients and credit score comes up, I would say around 700 is a good range to be like, okay, somebody is financially ready. If somebody is below 700, there may be a particular reason why. That comes to the next on some manageable debt to income ratios. So I like to think of debt to income as the quality of the debt to income. I would say a 40% debt to income may be different depending on the client. If somebody has a 40% debt to income ratio, but they are maxing out their credit cards and just paying the minimum $50 payment, then potentially that could be a sign that maybe these folks aren't necessarily ready. W-2 income or consistent 1099 income. So when we talk about income, we use the term stable and predictable income. We have a slide coming up that talks a little bit more about income, so I'll touch a little bit more on that. And then just trying to understand where clients' down payment funds are coming from. So just having a casual conversation, where's the money come from? Is it savings? Is it gifts? Just trying to get an understanding of do these individuals or couples have the funds ready to go?
Ryan, I'm curious if you don't mind, when you're working with a client that has a W-2 income versus a 1099 income,
Yep.
is there a significant difference in the time it takes you to kind of get them through to a pre-approval or to funding, or are the
Yeah.
timelines very similar?
No, it can be very different. So, when a client asks me, how long does it take to get pre-approved, I typically quote them 1 to 2 business days. And I usually say that just to give myself a little bit of breathing room if some other things come up. But in many cases, a W-2 person, I can get pre-approved same day. When you're dealing with somebody who is 1099, they're self-employed, they file everything in their tax returns, and the number that they may verbally give me as their income may not actually be the number that they're showing on their tax returns. So, and then depending on how complex somebody's tax returns are, that may require personal returns and business returns, which then can be quite complicated, which would then require, or which I would want an underwriter to review. So we try to set the expectation up front. I think we have a pretty good idea of the complexity of a client that we're working with just based on some questions we ask and how the conversation goes. But yeah, the timeline can be very different.
So it could be same day on the W-2, but you would put in some cushion if it's a 1099.
Yeah, yeah, most people, again, I can probably get them 1 to 2 days, but if somebody has some complex tax returns or some people don't even know how to access their tax returns, for some of them. So again, it's all about setting expectations on this timeline.
Great, thank you.
So these are some different behavioral signals that I see when we're talking to clients that are potentially thinking about buying. So one of the first questions I ask is, where are you looking to buy? And sometimes I'll talk to somebody and they're saying, I'm looking to buy in Colorado, Texas, or Maryland. And that's quite a range. If I'm talking with a client that is, focused, they know the state, maybe the county, maybe the town, that's a signal that they're ready to buy. They have a focus of where they want to be. We do talk to clients that are renting and they're talking about the landlord is raising their rents and they're getting frustrated about it. So if they talk about wanting to have an exit strategy with buying, that is a sign. And then Josh, you talked about it, family things come up. Maybe there's a couple that is looking to start a family. A lot of those different things where they, think about they want to buy something a little bit bigger. Maybe they want to get out of the city, move into the suburbs. So those are different things that give me signals that they're ready to buy. So these are, I would say, the most common loan programs that we work with, and I think I'd recommend all agents to have at least an idea of some of the particulars of these. But the most common is conventional financing, conventional loans. I would say probably the loans I do, it's probably about 97% of the loans I do is some type of conventional financing. As a first-time home buyer, you can do it with as little as 3% down for conventional. Um, so, and then with I do want to talk about this. This is something I feel maybe a little misunderstood in terms of just the monthly cost. I'll go on listings on Zillow and Redfin and those websites, and it gives you an estimate of what the PMI would cost. And usually it shows such a significantly higher number than what it actually is for a client. So those are one of the things why somebody may, want to wait until they have 20% down. But when you show them the figures and monthly costs, it does end up being significantly cheaper than what they expect.
And if you're an agent that wants to help someone better understand that, what would you recommend they do? How should they be thinking about
Yeah, so I would have them speak to a loan officer. That would be one of the first steps. Because from an agent's perspective, I mean, it can be really hard to quote what a monthly PMI costs. You can certainly give ranges, but you don't exactly know what the credit score may be. It could be a condo. If somebody does have a higher debt to income ratio, that could cause the monthly PMI to be higher. But again, connecting with a loan officer early in the process is really important. That way, it gives the client either some clarity one way or the other. Maybe it gives them clarity that, hey, we're really not ready yet. We really want to wait a year, and that's okay. But the agent and the loan officer has given that renter a good experience, and maybe they'll come back next year. Or maybe it does give clarity that, hey, this is actually more feasible than we thought, and we should take the next steps of getting properly pre-approved.
that? Gotcha. And then on the last bullet, it's not unusual to have a conversation with an agent who may not be aware of some of the options around 0% down.
Yeah.
So I'd love to hear more color on that one as well.
Yeah, so VA. So if you do have any clients that are veterans, they could be eligible for a VA loan. So it's zero, you can do it with 0% down and there's no PMI. It's really a great deal and honestly the rates do tend to be very competitive as well. There are some things to, be consider to be mindful whether a VA loan is appropriate, but it's very attractive if somebody's looking to buy that maybe either doesn't have the down payment funds or would prefer to keep them, for, future use.
Gotcha. Thank you.
Actually, Josh, can you go back one second? I just want to touch
Yeah.
on one thing on FHA. So just one thing that I've done this a couple of times this year with a couple of clients. So if you work in an area where there are multi-units with commercial space, though those don't qualify for conventional financing, but they do for FHA. So if you know of properties that are maybe 2 or 3 units, one of the units is for residential use, the other piece is for commercial space, that does qualify for FHA loans. I know sometimes those can be difficult to place. So don't, so if you have spoken with a loan officer before and felt like you couldn't make that work for any of your buyers, FHA does allow for it. So I have been successful a couple of times this year with those types of properties.
Gotcha. Okay. Well,
So these are some different support options for down payment. There's obviously down payment assistance programs. So here in Massachusetts, we have mass housing. There are down payment assistance programs there, so that may be appropriate for the buyer. It's not always appropriate, so that's a good thing to talk through with the loan officer, figure out the options. Is somebody eligible? There's typically some income limits, so it just depends on the client. There are co-borrowers, so maybe mom and dad want to co-sign, maybe brother, sister, grandparent. That might be appropriate depending on the client. Gifts, I mean, it's really popular these days. It feels like every week we got a loan coming in with some type of gift for mom or dad. So again, that can be a tricky situation to, ask one of your buyers, hey, can you get a gift from a family? But I'm sure there's a good way of approaching that. And then there are some grants and local state programs. Again, we are based in Massachusetts, so we are an approved lender of mass housing. But you can check with your local state and those programs to see if those programs are beneficial for your clients.
thank you. I'm curious on the gifts. If you had to guesstimate, is it for first time buyers, is it you're seeing like 1 out of 10, 1 out of 50? Like
I
how
would say
prevalent are
it's
these?
yeah, I would say it's closer to 20-25%.
Oh wow. So
Yeah.
maybe 1 out of every 4, 1 out of every 5 is getting some sort of help.
Yeah. I mean, maybe I'm overshooting a little bit, but it's
Wow.
yeah, it's a lot.
Okay.
And a lot of times and sometimes there may be a gift that doesn't necessarily need to be documented. Maybe somebody has enough funds to do it, but they're planning on mom and dad giving a gift after closing. So, you know,
Okay,
there does tend to be a lot of financial assistance from family members.
interesting.
All right, so these are some of the mistakes that we see a lot. So first is new debt. So I think most people think of you're a week before closing and then you go out and buy the brand new car and finance it. I don't, for my again, this is my personal experience. I don't see that a lot. What I do see though is that the people taking out the car loans a couple of months before they start the pre-approval process, before they start shopping. So why is that a mistake? Well, you would bring on more debt, which then could potentially change the qualification. Maybe they don't qualify for 500,000 anymore. Maybe we have to scale it back to 400,000 because they have a new car loan. Um, I've mentioned with a higher debt to income ratio that could increase the monthly PMI. So if someone's putting less than 20% down because they bought the car, now maybe they're paying more on the PMI front. So not so much you get to the 1 yard line and then we have to decline them, but it could potentially change the terms before, we start the process. So moving money between accounts. So this would also be an area that I wouldn't say is going to cause something to not close, but it can be a point of frustration for our borrowers. So what we try to do is we try to do our best to limit the documentation that we require. But if someone is consistently moving money around, we are going to have to document and source it. So someone might just be thinking, I'm moving $10,000 from my Capital One to my Chase account, thinking nothing of it. But then we have to document it on bank statements. And sometimes the new bank statement isn't available. Then we're asking for transaction histories. And what happens is now the client has a bad experience towards the end, and that's what we don't want. So we try to say, leave the money where it is. We've already documented, and then we let them know when it's okay to move it if they need to do that. Job changes. So um, it happens. Uh, I would say many times it happens. We might do a pre-approval for one client, and then we're looking to renew it. Maybe they took themselves out of the market for whatever reason. They come back looking for an updated pre-approval. They tell me nothing has changed. Sounds good. And then they're looking to do a rush closing. Great. We're happy to accommodate them. And then they forgot to tell me that they actually changed jobs and maybe they move to more of a commission-based job, maybe more of a bonus structure, whatever it may be. So those are certain things that we see. Not so much someone taking a new job right in the underwriting process, but potentially, not communicating that after we've been working them for a while. Taxes and insurance. So these are costs that I don't want to say I'm always surprised, but these are costs that I think many buyers don't have a good grasp around. When we're doing pre-approvals, one of the questions I ask is, what are you thinking the property taxes are going to be? Do you know the tax rate? Where are you looking to buy? So we do our best to estimate it, but then when the tax number comes in, it always can be a little bit more expensive than what they're thinking, which then means the monthly payment is maybe more than they feel comfortable. So um, we try to do our best to, again, set those expectations, give them an idea of what we think insurance and taxes are going to cost. That way they start feeling comfortable with the payment before they even submit an offer on any home. And then, I mean, one of the first questions I get with new prospective borrowers is, what's our interest rate? And they might be 12 months out from really being serious about buying something, and they're a little fixated on the rate before they've even stepped foot into an open house. So again, we can't control rates. We try to set expectations. We try to give them what we think is going to happen. We try to give them some history of what's happened in the past. Um, but a lot of times they decide, they're going to buy a home based on a specific interest rate versus making sure that that home fits their needs.
Thank you. And Ryan, this is such a sad slide. You've got someone who is ready to borrow, ready to buy, and then something goes wrong. from your perspective as a loan officer, how can an agent help you with this? What is it that an agent could do to try to help avoid these situations?
Yeah, so I mean, we talk about, starting things early. Um, that way we can we can sort of take a breather. We can sort of take our time, give them an outline of what to expect, not just now, but into the future, things not to do. Um, and then the agents can sort of reiterate, like, don't take on new debt, try not to move money, help them understand what property taxes are. If they're going to look at a home, what's the annual property tax amount? Show them what the assessed value is. Maybe there is going to be a massive adjustment when they go into that home. We're seeing that a lot. We're seeing that a lot where I live in my town is that the home values have gone up so much and the assessed values they haven't been updated. And now the towns and counties are finally getting to that and the tax rates are going up and the tax amounts are going up. So um, anything you can do just to prep the buyer, not just now, but when those bills start coming in.
Thank you. Okay, thank you.
All right. So this is a little bit of a timeline or, some information about, these are the real costs of what to expect. So first is the down payment, 3% down, first time home buyer is the minimum. If we're doing conventional, typically 3.5 to 20% is what we typically see. Then there's closing costs. So this can vary across the country depending on where we are. I would say that, I probably estimate around 1.5 to 3% of the purchase price, but it really can vary. There are certain states that have the mortgage taxes, like Florida, New York, Maryland, Minnesota. They have the mortgage taxes there, and then like a state like New Hampshire, they have the transfer taxes that the buyer is responsible for. So if I know we're going to be originating a loan in a certain state, setting those expectations of what the closing costs are going to be, because I know certain states are going to be significantly more expensive than others. Then there's the prepaids and escrows. So one thing that a lot of buyers don't know is that home insurance has to be paid in full for the first year prior to closing. They think that it can just kind of be a monthly thing, which, yeah, once the first year is paid, but in the beginning, you got to pay for the first year. So that is something that's somewhat unexpected. But again, we try to tell them up front. And then your home insurance, your property tax escrow. So depending on, again, where the property is located in the tax schedule, we may need to collect up to 11 months of property taxes to hold into an account. Those are those are costs and funds that many times they're not ready for. So again, we tell them up front, that way they can start preparing. And then this is something I think doesn't get talked enough about. Once the home is closed, they're in there. The loan is closed. These are the funds that somebody needs after they've moved in. So I try to give my own personal experiences. I've owned two homes. The home that we're in now, we have oil heat in my home. So the first thing we did, it was cold when we bought the house, is we brought the oil company in, signed the service contract, but they wanted to do they wanted to check the oil tank, make sure it was in good shape before they filled it. And they found a very little small pinhole leak in it. So they wouldn't fill it until we changed it. I didn't even move my bed into the house yet. $3,500 later, new oil tank. And for some people, they may not have that. They may have put all their funds in that down payment and closing costs. So for many loan programs, what's if you're not familiar with the term reserves, that means a certain amount of months of mortgage payments held, for liquid use after. Um, a lot of times it's not a requirement for underwriting, but we do try to coach our clients to make sure that you do have some reserves that if emergency things come up, you're ready to go.
All right. Let's see. Transitioning Ryan into what agents can do immediately, and then after that, getting your opinion on, of course, I'm sure you would say that you are the loan officer every agent should be using, and you're probably right. But I think you'll probably have some great perspective and advice for our agents about how they should think about finding a loan partner.
Yeah.
So we'll cover that stuff before we wrap up.
Yeah, so these are a lot of the objections that we hear, and I'm sure as agents you guys hear as well. Uh, People don't want to buy because they feel like the rates are too high. So one of the things that I do is I try to just put in a little bit of perspective on rates. I do like to show them the difference in monthly payments between difference of interest rates. Many times they realize that, the change in monthly payment is not going to change their quality of life. It's not going to change their day to day. Again, I try to be on their team and I say, listen, I'm frugal, I want to save money, but you know, 50 or $60 a month is, many people aren't really going to notice that. I try to give some perspective on where rates have been. Again, the average first-time home buyer, some places have it at 40, some places have it at 36. But for the most part, those clients, they only know low rates. They only know from 2009, 2010, where the market was sort of held, low for a very, very long time. And again, try to put in perspective that in 2018, the average rate was around 4.5. So we're not that far off from where we were in 2018. And then, of course, they'll pass, from 2020 to 2023. Market was obviously incredibly low due to the pandemic. Again, that's something that we'll hopefully never see again. So again, we try to put in some perspective of where the market has been. Um, and then we try to say, okay, what are things that we can do in the future? You can always refinance later. If the mortgage rates go down, you can always take advantage. And then I always like to, always be the devil's advocate that, if mortgage rates go down significantly, well, what happened? What does that mean for retirement accounts? That also means increased competition.
Yeah, fair points.
So a lot of clients, again, they feel like they don't have enough for a down payment. 3%, 5% down, first-time home buyers, that's typically always available. There are down payment assistance programs that we mentioned, and gift funds, again, are still very common. Um, So, one of the things that I did with a first-time home buyer, they actually closed last week. They were in a rental for 15 years, the same rental. The landlord wanted to sell the home, so they reached out to us. We started working with them. Again, it was this couple that really, I think they thought they would never actually be homeowners. They never thought it was attainable. We had to work through some debt to income issues, but one of the things that we were able to do is they had a car loan, and I think they had about 7,000 on it. What they did was instead of paying off the full 7,000, all you had to do was pay off half of it. And as long as the balance is in the monthly payment requires only 10 more payments. So if let's say your monthly payment is $500 and you pay your balance down to 5,000, we can remove that debt on a car loan and we don't have to account for it. So those are little strategies that we can do that if a client has the funds ready to go, then we can help out with their debt to income. And okay, so we mentioned before about, W-2 issues. So just some things on self-employed clients. So we do need a 2-year history. So we do need 2 years of tax returns. And this is one of the things why it's important to get in touch with a loan officer really early on in the process. So again, whether you want to work with me or anyone else, get in touch with a loan officer because we can start preparing these self-employed clients for what to expect. Maybe they're a newer business. And maybe year one wasn't great and they're ramping things up, but year two, they did really, really well. And they think they can qualify for whatever they're looking for. But in reality, we're gonna average out those 2 years. And then their income is not as high as they're expecting, and maybe they're not qualifying for the type of home that they're looking for, but we can prep them so then they know what to expect in the future years. And just as far as W-2s, so we work with a lot of students, or recent students. They may have maybe gone to grad school, but maybe they're ready to buy. Maybe mom and dad's helping them out with a down payment. and maybe they've only been at their job for 5 or 6 months. That's okay. As long as it's a regular salary position, they only need to be at their job for 6 months as long as we have a proper 2 year history of what they've been doing. Okay, so from my perspective, we want to be an extension of the agent. The agents do so much in the transaction. They've got a lot of things they have to work through. We want to be an extension of you. So you're going to get a lot of questions on, down payment and credit scores. And, again, you're not there to be a financial expert. That's why you send them over to us. We take care of the financing. Um, and again, we sometimes it doesn't work out. Sometimes we go through the process and we come to the conclusion that maybe this just isn't the right time. That's okay. We've given them a good experience, and hopefully we can all work together down the line. And then again, other times people realize that it is possible to do this right now.
And Ryan, I would add on this slide, and I've heard this from multiple agents, um, which I find really interesting. They think of their loan officer partner essentially as a sales tool, right? So their client is making a huge decision. It's a big financial commitment. You're essentially saying, this is what I want my lifestyle to be like, my neighborhood, my school, et cetera. Overall, it's a very big decision. It's not one you make overnight. You're kind of progressing in steps. And what I've heard from agents that I didn't think about, I think is really interesting is if I hit a roadblock with my renter or a buyer and I want to accelerate things, I will just say, hey, you don't have to make a decision here. Just talk to my loan officer, this partner that I've worked with,
Mhm.
right? And so all the agent is asking them to do is have a conversation to become better informed. The agent is not actually asking them to become a buyer. And I thought that was a very interesting way to take a gradual, easy step with your client that will progress them to becoming a buyer. So I just wanted to call that one out on this slide as well.
Yeah, and I think just just continuing the process is important. I think there's a lot of people out there who they kind of begin thinking about buying a home and they casually look online. Maybe they could get connected with an agent, but either life gets in the way or they get discouraged on pricing or whatever. But just by introducing to a loan officer, they're just kind of continuing to take the next steps of what they need to do. And again, sometimes that can just be enough to get them you know to the finish line.
And I think you probably already implied the answer to this, but spell it out. When should an agent introduce in a mortgage professional?
Yeah, I would do it right away. Um, for a few different reasons. One is we've talked about it from an agent. So you can use this as a sales tool. You're full service. You got a lot of connections. You're gonna make the buyer's job easier when it's already an incredibly stressful situation. Um, Also, it saves you time, right? So the last thing you want is to spend weeks and weeks with a potential buyer just to realize that they've got significant credit challenges, they've got down payment issues, right? So vetting some of your clients saves you time, which then, helps you work with more qualified buyers. Um, so, again, I would start right in the beginning. There is no wrong time, but, starting early, one also allows me to work with the client for a little bit. And if there are issues that we need to work through, we have plenty of time versus their dream home just came on the market. They want to place an offer, and we've got a lot of things to work through before we get to that point.
Gotcha. And we're a little kind of getting down to the wire on time, Ryan. So maybe you could
Yeah.
run through these quickly, but help the agents, particularly the newer agents, think through how they should be evaluating a loan officer that they may work with.
Yeah. So um, I think what I pride myself on, just for again my own experience, is just being available. I think that's one of the most important things as when you connect with a loan officer is are they available? If it's 5 o'clock on a Sunday, do you need an updated, can you get me an updated pre-approval? I think that's really important. But these are all, some of these are the questions that, you can work with you can work with a loan officer. We can all do a phone call together. understanding, figuring out the finances. Is the home price going to be in line with what the monthly payment expectation? Is there a gap, or, are the buyers in a price point that matches what they need from a monthly payment perspective?
So if you were in their shoes and you were shopping for a partner on the mortgage side, are you looking for a particular level of experience? Is it really kind of your most pressing need would be about availability? Like, how are you thinking about that?
Yeah, I think experience is important. I would say I wouldn't say it's all that's important. I would say I think I'm relatively seasoned, but there are loan officers that have been in this industry for 30 or 40 years. So I would say, I'm probably on the younger side, but I think I do a pretty good job, and um, availability is incredibly important. And it's not even so much during like the pre-approval stage and figuring out, what are the loan options. It's 2 days before closing and the buyer has a significant question. They're concerned about cash to close. That's when it gets really stressful. And being able to call the loan officer and get them on the phone pretty quickly is really important, because a lot of times, sometimes the loan officer checks out at the end. There's a lot of people that have their hands a part of this transaction. There's a processing team, but having the loan officer able to answer the phone is incredibly important.
Gotcha. Thank you. Well, so thanks so much, Ryan. We do have some questions, so I'm going to quickly do a little sneak peek, and then I'm going to ask your help, Ryan, for some of these questions. So I did, for everyone on the call, I did want to quickly review a product that Rental Beast will be introducing. It will be a member benefit, so it'll be available to you. And the point of this platform called Renter Lift is to help you nurture your renter clients into buyers. A lot of agents say, yes, Josh, I'm aware that future buyers come from rentals, but that doesn't mean it's easy, right? So for Rental Beast, the challenge that we took on was, how can we make this easy for our agents? And essentially the idea is this: you invite renter leads in. We have renter leads as well that we are pushing into this Renter Lift platform. This platform is intended to help renters grow into future buyers, into first-time buyers, and I'll explain how in just a second. And when they're ready to buy, we return them to you. So you send us a lead, we'll incubate it and bake it out for you, and when they're ready to buy, we're going to give it back to you. So what is the Renter Lift platform doing for your clients? So it's all about helping them understand the budgeting. A lot of things we've talked about today, right? The education, helping them understand how much the costs actually are, what are the closing costs, what are the ongoing costs. We help them improve their finances, right? So through things like rent reporting to the credit bureaus, and other tools and tactics that may help them financially become better prepared for a buyer. We're doing all that. And we're also helping them understand what they can actually afford in their budget. So there is home search. They can actually see and kind of understand the houses that they could buy, and they can take action from there. While this is going on, so while your client is in this platform, we keep you informed of what's going on. Your lead, it's your client, right? So your lead will always stay your lead. We make sure that you are the only agent involved, and it's a member benefit. It would be free. It's a free service to you. I would think of it this way. Hopefully, through this webinar, you've gotten an understanding that renters are future buyers. It's a huge market, and there is a steady flow of renters that are transitioning into buyers. If you understand what to look for, if you understand the common problems and are able to address those, you're taking a huge step forward in helping your future self, helping transition buyers that are currently renting, and maybe first-time buyers in the next 6 to 12 months. So those skills, right, you will gain through this and through Rental Beast University. anyone who seems like they may be down the road as a buyer, it's as easy as inviting them into this renter lift platform. We will incubate them for you, we will nurture them for you. And as they approach becoming a first time buyer, we will let you know so that you can re engage. So we're really excited about that. That's coming out. It's being rolled out kind of across the country over the first quarter. There will be announcements, so stay tuned for that. Just some key takeaways. Again, a lot of what I've just mentioned, renters are the primary channel for first-time buyers. There is a massive pool of renters. Approximately 40% of the housing market is renters. So if you're able to be smart about positioning yourself to capture these as first-time buyers, you will be enormously successful in this market. So you want to understand what a future buyer looks like, and you want to understand how you can leverage tools, including Renter Lift, but definitely your loan officer partner to make this happen. All right, we're going to do a few questions. If you're interested in more information or signing up for the wait list for Renter Lift, you can scan that QR code. And Ryan, I wanted to go through, there's a handful of questions in here that I think you would be best able to answer. The first question is about the credit score. We've heard a lot about new versions of the credit score, maybe getting away from some of the more traditional measures. I'm kind of curious your reaction to that.
Yeah, right now it's more of the traditional credit score. We'll see if things change down the line. But right now it just be more your traditional credit scores.
That's the most prevalent. What about, can you talk about student loan debt? We hear a lot
Mm.
about that and that being something that holds buyers back. Are you seeing that a lot? How are you able to deal with it, if at all?
Yeah, so definitely. So I would say that is one of the reasons why we got debt to income ratio issues. So if we always have to account for it, whether their payments are deferred or not. So in many cases, we still have to use a 0.5% to 1% of the current balance on the loan. So for many people, that could be a reason not to get qualified. How much I'm seeing, I don't know if I can give an exact number. Um, but it does become an issue for certain clients.
Gotcha. Okay. I have a question about, and I have an answer to this, and then I'd be curious about your take, Ryan. But one of the agents asked, um, should they always use the same loan officer? I will, from the Rentalbees perspective, say that we run agent surveys fairly regularly, and we see a pretty kind of even distribution. We have a number of agents who have a loan officer that they use. It's, their guy or gal. But we also see a lot of agents who indicate that they have two or three loan officers that um, they tend to work with. I'm kind of curious about your take on that one.
If I was an agent, I would have a couple of different loan officers to work with. One, you don't want to have all your eggs in one basket. Sometimes, for whatever reason, maybe one lender can't get a client qualified. Again, for whatever reason, maybe the rates are off a little bit. Maybe personality wise, sometimes you just don't get along with the client. It just doesn't work out. But having a couple of different people that you trust, a couple of different loan officers that you trust to refer, that way, then, you're not necessarily saying, hey, go work with, Ryan at Leader Bank. Go talk to Ryan at Leader Bank and go talk to, Jim Smith at wherever. At least it gives the buyer a couple of different perspectives to talk to.
Gotcha. And unfortunately, we have way more questions than we do time, but should I be having a renter to buyer conversation with all my renters? Let me handle this one. I would say to the agents, I think on this call, we tell you, hey, the median age is 40 years old, and this is kind of what a buyer looks like. You have the advantage of actually interacting with this person, kind of being on the front lines and being able to have a conversation with them. I would absolutely encourage every agent out there to just ask, right? Like you're talking to this person, you're building a relationship. There's no reason you can't ask to see if they are kind of thinking about buying and maybe why or why not. No reason not to have that conversation in my mind. Um, the, We have a few questions about is this being videotaped? This webinar is being videotaped, and we're happy to make content available, and we'll probably send out some additional helpful content as well. And yeah, I think that's it. Let me wrap the call up by thanking Ryan for his time. It was really helpful to hear the mortgage perspective of all this. And of course, thanks to all our participants, to all the agents out there who joined us. We really believe that we are kind of in a time where it's very important to think of renters as buyers, and we will continue to emphasize this topic over the coming year. So thanks everyone for joining today.
Thank you, everyone.